Most traders think losing a trade is what kills their account. They obsess over stop losses, risk management, drawdowns, all the things that go wrong when a trade moves against them. But here is the truth nobody talks about. The trade that wins is often the one that destroys you, not because you lost money, because you won it the wrong way. Today, I am going to show you exactly why a winning trade is more psychologically dangerous than a losing one. I am going to walk you through what happens inside your brain after a win, how it rewires your behavior without you even noticing, and why most blown accounts trace back not to a string of losses, but to one big win that came too early. I have been studying trader behavior for years, and the pattern I keep seeing is always the same. A new trader hits a big win, feels invincible, doubles their lot size, skips their rules, and blows up within 2 weeks. It is not bad luck. It is not a bad strategy. It is the win itself that planted the seed. The losing trade taught them nothing because they never felt the consequence. The winning trade taught them the wrong lesson, and that lesson stuck. This is not a motivational speech. This is a breakdown of a real psychological trap that is sitting inside your trading right now. If you have ever gone on a losing streak right after your best trade, this video is the explanation you never got. Pay attention, because what I am about to show you changes how you see every single trade you take from this point forward. Now, before we get into the mechanics, let me tell you why I can speak to this with confidence. I have watched traders at every level make this exact mistake. Beginners, intermediate traders, people with years of screen time, all of them falling into the same trap after a winning trade. The pattern is so consistent that once you see it, you cannot unsee it. The reason most trading education misses this is because it focuses on strategy, entry points, exit points, risk ratios. Nobody talks about what a win does to your decision making. Nobody explains that your brain treats a winning trade as confirmation that you are special, that your instincts are sharp, that the rules are for people who do not understand the market the way you do. That is the trap, and it is invisible until you are already in it. I have gone through this myself. Hit a clean trade, felt the rush, told myself I finally figured it out, and then proceeded to hand back every pip I made, plus more. Not because the market changed, because I changed. The win changed me, and I did not even realize it until the damage was done. That experience is what I am handing to you today, so you do not have to pay for it yourself. So let me explain the core concept here before we go deep. Every trader knows that dopamine is released when you make money. What most people do not know is that dopamine does not just make you feel good. It also suppresses your ability to evaluate risk accurately. After a win, your brain is flooded with a chemical signal that says, whatever you just did, do it again, do it bigger, do it faster. That signal is not logical. It does not check whether your win came from a clean setup or from a lucky entry on a random candle. It does not care. All it registers is, you won, repeat the behavior. This is called operant conditioning, and it is the same mechanism that keeps people pulling slot machines. One win rewires the loop. You stop trading your system and start chasing the feeling. This is the core concept. A winning trade, especially a big one or an unexpected one, triggers a neurological response that makes you more impulsive, less disciplined, and more likely to overtrade. The win does not make you better. It makes you reckless, and reckless traders do not survive this market regardless of how good their strategy is. Now let us get into the real meat of this. Let us walk through exactly what happens step by step after a trader hits a winning trade, and I want you to watch yourself in this scenario, because I guarantee you will recognize your own behavior here. You take a trade. Maybe it is a clean setup, maybe you jumped in on gut feeling, does not matter. The trade goes in your favor. You close it, you see the green number, and immediately something shifts inside you. Your posture changes. Your confidence spikes. You feel like the market owes you more. That last part is the dangerous part. That feeling of the market owing you more is where the spiral begins. You go back to the chart not to find a setup, but to find permission to trade again. There is a difference, and it is massive. Finding a setup means you are following your process. Finding permission means you are looking for anything that justifies getting back in, because the dopamine wants another hit. You will find that permission whether the setup is there or not, because your brain is now motivated by feeling, not by logic. So you enter again. Maybe the second trade works too. Now you are really in trouble. 2 wins in a row, and your brain has built a narrative. You are on a hot streak. The market is moving your way. Your reads are sharp today. This is your day. That narrative is a lie, but it feels more real than anything your risk management rules ever told you. So you increase your position size, not by your plan, just by impulse, because why would you take a small position when you are clearly reading the market perfectly right now? Then the third trade comes, and it moves against you. Under normal circumstances, a losing losing trade is fine. You take the loss, you move on, the system absorbs it. But you are not operating under normal circumstances right now. You just doubled your size. And because you feel like the market is supposed to be working for you today, you do not accept the loss cleanly. You hold, you move your stop. You tell yourself it will come back. That is not patience. That is a trader who cannot accept that the narrative he built in his head is wrong. This is the moment where accounts get destroyed. Not in one trade, but in the 3 or 4 trades that follow the big win. The win sets the emotional state. The emotional state drives the decisions. The decisions ignore the rules. And the market does not care about your emotional state at all. Now let me show you the second layer of this, because it gets even more specific. There are 2 types of wins that do the most damage, and they do it in different ways. The first is the unearned win. This is a trade you entered without a clean setup, maybe on impulse, maybe on a tip, maybe just because the pair was moving and you did not want to miss it, and it worked. The market moved in your direction and you made money. The unearned win is catastrophic because it validates the wrong behavior. Your brain does not distinguish between a disciplined entry and a sloppy entry when both make money. It just logs. Impulsive entry equals profit. Now your system is corrupted. The next time you feel like skipping your checklist, your brain will remind you of that time you skipped it and made money. You will skip it again and again until the market finally punishes you for it. And by then, the habit is already formed. The second dangerous win is the oversized win. This is a legitimate setup that just happened to go much further than expected. You aimed for 30 pips and got 120. You feel like a genius. And the problem here is not the trade itself, it is the new benchmark it sets in your head. Every trade after this will be measured against that 120 pip win. A clean 30 pip result will feel like a failure. You will start letting trades run past your target looking for the big move again. You will miss exits. You will watch winning trades turn into losers because you are chasing the memory of one exceptional result. Both of these wins do the same thing at the root level. They distort your perception of normal. And when your perception of normal gets distorted, your execution falls apart. You cannot trade a system consistently if you do not have a stable baseline for what a good result looks like. Let me give you a real scenario to make this concrete. Imagine a trader takes a short on a currency pair after price rejects a key resistance level. Clean setup, everything aligns, he targets 50 pips with a 25 pip stop. The trade runs and he gets his 50 pips. Good trade. But then price keeps dropping. He watches it go another 80 pips past his target while he is sitting on the sidelines. Now he feels like he left money on the table. Next setup comes. Same structure, same resistance rejection. But this time, he does not set a 50 pip target. He tells himself he will let it run this time, chase the bigger move. Price hits 40 pips in profit and then stalls. He does not close. He wants the 130 pip move like last time. Price reverses. He watches the trade come back to break even. He still does not close because he is now emotionally anchored to the idea of the big win. Price keeps going and now it hits his stop. He turns a winning trade into a full loss. The previous win did not make him better. It made him worse. That is the trap. Now here is what you actually do about this, because understanding the psychology is only useful if it changes your behavior. The first thing you need to implement is what I call win accountability. After every winning trade, before you touch the chart again, you ask yourself 3 questions. Was that a clean setup by my rules? Did I exit at my target, or did I let emotion drive the close? Am I feeling the urge to trade again right now, or am I operating from my process? If the answer to any of those questions is uncomfortable, you step away. Not forever. Just long enough to let the dopamine spike settle. 15 minutes, 30 minutes, whatever it takes. You do not trade on the high of a win any more than you trade on the desperation of a loss. Both emotional states compromise your judgment. Both cost you money. The second thing you do is cap your session after a significant win. This is a rule that very few traders follow, but the ones who do protect their accounts far more consistently. If you hit your daily profit target in your first 2 trades, you are done for the day. Close the platform. Go outside. The temptation to keep going when you are up is just as dangerous as the temptation to revenge trade when you are down. Both are emotional trading. Neither belongs in a professional approach. The third adjustment is position size discipline after wins. Most traders increase size when they are confident. That feels logical, but it is exactly backwards. Confidence is an emotional state, not a market condition. The market does not become easier to read just because you are feeling sharp. If anything, your elevated confidence makes you less careful about the setups you take. The right move is to keep your position size identical after a win, not larger until you have a full session of clean execution behind you. Now let us connect all of this directly to your money, because this is where it gets real. Every trader wants to know how to make more, but the fastest way to make more is to stop giving back what you already earned. And the data on this is clear. Most traders give back the majority of their profits, not during losing periods, but during the trading session that immediately follows a big win. Think about what that means for your account. If you are consistently making money in your good sessions, but then handing it back in the sessions that follow, you are not dealing with a strategy problem. You are dealing with a win management problem. Fixing your entries will not help you. Better analysis will not help you. The only thing that helps is recognizing that the emotional spike after a win is a threat to your account, treating it that way, and building rules that protect you from yourself. This is also where traders who make it long-term separate from those who do not. The ones who survive are not necessarily smarter or more skilled. They are more honest with themselves about what they are feeling after a win, and they respect that feeling enough to put guardrails around it. They know that their biggest enemy is not a bad market or a bad signal. It is the version of themselves that feels untouchable after a big green trade. And when you start operating this way, something interesting happens to your equity curve. It stops being volatile. The wild swings that defined your early trading, the days where you made a lot and then gave it all back, they start smoothing out. Not because you are winning more trades, but because you are protecting the wins you already have. That consistency is what builds real confidence. Not the artificial high of one big trade, but the quiet certainty of knowing you can execute cleanly day after day. That is the real edge. Not a secret indicator, not a hidden setup, not a new strategy. The edge is emotional regulation after a win. It is one of the least talked about skills in trading and one of the most profitable ones you will ever develop. If this video shifted how you see your wins, do me a favor and hit the like button right now. It takes 1 second and it helps this kind of content reach more traders who need it. Subscribe if you are not already, because we go this deep on trading psychology and execution every single week. No surface level content, no recycled tips, just the real stuff that actually moves your trading forward. And here is what I want you to think about before the next video. If winning trades are dangerous, what does the most dangerous moment in a trading session actually look like? It is not what most traders think. It is not a losing streak. It is not a missed trade. It is not even a big drawdown. The most dangerous moment is something much more specific, and I break it down completely in the next video. Watch it next. You will not look at your sessions the same way after.